In this week's video, we'll cover what may turn out to be the mother of all stock market signals. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. The three main bullet points for this week's video. Number one, what was helpful before, during, and after the U.S. election? What was not particularly helpful before, during, and after the U.S. election? And most importantly, what can we learn from it? If you've taken the time to read any of the Market Wizards books, you basically know their interviews. So here's one of the questions from Market Wizards. What are the traits of people who are successful in this business? Answer: they're open-minded and flexible. They're also risk takers because they believe in what they're doing. Thus, on November 5th, 3 days before the election, when we're tweeting something like this, it's our way of saying we have to remain open-minded and flexible over the next few days and weeks. November 5th, history tells us forecasts and anticipated market reactions can be way off. This is 3 days before the election. Also, 3 days before the election, you may remember the S&P 500 was down 9 sessions in a row. This is a tweet from November 5th. And we all remember that the forecast for the U.S. election, if Trump was victorious, was not particularly friendly for stocks. Deutsche Bank, European stocks could plummet 10% if Donald Trump wins. Citigroup, stock market will fall if Donald Trump is elected president. Up here, IBD, FBI reveals more evidence that stocks will fall if Trump wins. Now, obviously, if we had paid attention to these forecasts or things that might happen rather than focusing on what had already happened and, more importantly, what was happening at the time, it would have been very difficult to make the chess moves that we needed to make before the election, on election day, and during election week. Clients and those who follow along on Twitter know that we made a flurry of moves on election week. The election was on Tuesday. We actually added to growth before election day. We added to growth on election day. And the data and the observable evidence, rather than fear of what might happen, also told us to start cutting our remaining conservative positions. All of these tweets dated between Monday, November 7th and Friday, November 11th, basically say the same thing. We were adding to growth and we were reducing the conservative side of our portfolio and even eliminating some of our conservative positions. Based on this theme, on election day, we tweeted today, we are looking at hard data and relative asset class behavior to help answer what is the market telling us on election day. Fortunately, if we fast forward to the present day, it's basically been telling us the same thing. The first election-related chess move was made on Monday, November 7th. Therefore, the close on Friday, November 4th is relevant here. And what these two tables show us is these are your winners or your outperformers between November 4th, which was the Friday before the election, and Thursday of this week, which is January 26, 2017. The message that asset class behavior is sending today was basically the same message that was being sent before, during, and immediately after the U.S. election. These are growth-oriented ETFs. They're all outperforming the S&P 500 here. ETFs that have been underperforming are heavily slanted towards the defensive side of the ledger. Healthcare, staples, utilities, bonds, silver, gold-related ETF, bonds, and VIX-related ETFs. Given what we know as of the close on January 26th, similar to what we saw on election week, This is a confident look. This is confident asset class behavior. The conviction to own growth-oriented ETFs has been increasing, and the conviction to own defensive-oriented ETFs has been waning. From a confidence perspective and having the ability to pull the trigger and listen to the hard data, we also had fundamental backing. You might remember on November 11th, which is Friday of election week. The election was on a Tuesday. This is the following Friday. We covered some of the fundamental reasons why some sectors might benefit from a Trump administration and why some sectors may be laggards. Asset class behavior has basically been confirming what we covered on November 11th. Many of the asset classes that we talked about in that video favorably, if not all of them, are shown here. And in that video, we talked about how it may impact bonds. Bonds have lost money since November 4th. Next, we'll cover quickly an example of that hard data heading into the election and immediately after the election. And we'll tie it into the present day by covering a new topic on a new time frame. The purpose of this exercise is not to imply that everything looked rosy and wonderful heading into the election. That's not true. What did look good was the longer term data that we had in hand. Unquestionably, the shorter term data as reflected in the S&P 500's 50-day moving average was concerning. But we had a lot of longer term data in hand that helped us keep that open mind that we needed heading into election day, including the signal that had only occurred 10 other times in the last 35 years that we covered in a video back in August of 2016. That was the analysis with the for illustrative purposes only 30, 40, and 50-week moving averages, and we knew that those signals typically are not quickly reversed. Sometimes you get a whipsaw in a difficult period, but more often than not, when blue moves to the top here, good things happen for a relatively long period of time. We had just had a whipsaw, and the probability of getting whipsaws back to back seemed relatively low, especially given the look of the charts heading into election day. These are the same moving averages from that analysis, the 30, 40, and 50. This is the look that we want to avoid. You can see on October 14th, this really doesn't look anything like this. And the October 14th look, and even Friday, November 4th, here, the Friday before the election, this, nor this, really looks anything like the early stages of a high-risk period, similar to the turn when the dot-com bubble was bursting. This is observable evidence. We can see it. We had this in hand heading into election day. And as we can see on Friday, December 9th, the observable evidence never deteriorated on this chart in any meaningful way. December 9th really doesn't look anything like this higher risk period, nor does December 9th look anything like this higher risk period in calendar year 2008. If we fast forward to the present day and look at sector performance, looking backwards 3 months from Thursday, January 26th, this performance is telling a story. Our leaders are clearly growth-oriented ETFs, and our laggards are clearly defensive-oriented ETFs like XLP, XLU, and healthcare. We know asset class behavior looking back 3 months is favorable, and we've covered numerous things on charts or forms of observable evidence that look good. Is there anything else? As you might have guessed based on the title of this week's video, the answer is yes. This is the NYSE Composite Stock Index on Friday, January 27, 2017 at 1:35 p.m. Eastern Time. This is a consolidation box or a trading range that dates all the way back to June of 2013. In July of 2014 and the spring of 2015, we were unable to break out of this trading range. In the present day, January 2017, the market is trying to break out. And I want to emphasize, we really won't know if this breakout is successful or not, maybe for several months. As we saw with the S&P 500, sometimes you get a breakout, and sometimes your retest includes coming back into the range. We'd prefer not to do that, but we could see the NYSE bounce around this area for some time before it decides which way it wants to go, up or down. But the evidence that we have in hand right now shows what appears to be a bullish breakout. Whether or not it holds, that remains to be seen. And if we move out to 30,000 feet and look at the same box here, market fractals tell us if a breakout from this box is important, then a breakout from a longer-term box can be important as well. 2007 high here, it was exceeded. Here's a case where you break out and your retest involves moving back into the range. We'd prefer not to see that, but now we're back above the range. So we do have a breakout out of this box here. But if we move out to 60,000 feet and use the high here and the low here, rather than drawing this box, the NYSE Composite Stock Index was inside of this consolidation box for almost 20 years. And this could be the mother of all breakouts. Price is clearly above the 2007 high, which is this big box here, regardless of whether or not this smaller breakout holds in the short run. The longer we stay above the 2007 high here, the more meaningful it becomes, which allows us to circle back to one of our Market Wizards quotes. The second item is something that Ed Seykota taught me. When a market makes a historic high, it is telling you something. No matter how many people tell you why the market shouldn't be that high or why nothing has changed, the mere fact that price is at a new high tells you something has changed. On Thursday, January 26th, price is up here and clearly above the 20-year consolidation box here. Why are we saying this could be the mother of all stock market signals? And note, we're saying it could be, and it might turn out to be. It's way too early to tell whether either of these breakouts will hold in the long run. As we always say, the longer we hold above, the more meaningful it becomes. The longer we hold above, the more meaningful it becomes. We're not forecasting here. We're talking about something that we have in hand right now. Price is above this box, and this week price was above this box. If we move out to 90,000 feet and look at the same NYSE Composite Stock Index, this time using a monthly chart dating back to calendar year 1965 on the left side of your screen, and this is the present day 2017 on the right side. We've covered this chart, but we haven't covered it for the NYSE. We've covered it for the S&P 500. So this is a new analysis here. We have a consolidation box here that lasts for 17 years. Price is inside the box from 1965 to 1982. And we know from past videos and from fractals that the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or a bearish breakdown. And in this case, after a bullish breakout in 1982, stocks, the NYSE Composite, the broad NYSE Composite, gained over 1,000% over the next 18 years. This is consolidation, and this is a long-term secular trend. Harder markets are typically followed by easier markets. How does this apply to the present day? We just showed that good things happened after price broke out of this 17-year consolidation box. And regardless of what happens in the short run, price is well above this 19-year consolidation box that dates back to 1997. The bullish breakout occurs in calendar year 2016. And obviously, this is a very small sample size and anecdotal evidence, but when we had a 17-year consolidation, good things happened over the next 18 years. In the present day, we have something similar, but this box is actually longer in duration it's 19 years. Obviously, when we're using a monthly chart and looking at a chart that dates back to 1965, we're looking at very long-term time frames. We've mentioned in past videos, really any system in the markets that works on a 60-minute chart should work on a monthly chart, a daily chart, a weekly chart, a 10-minute chart. That's market fractals. Therefore, all of the principles that we've covered in these videos and all the principles used by the market model should also apply to this chart. Was there anything we could have used after the bullish breakout in 1982 to monitor the health and, more importantly and more realistically, the risk-reward profile of the NYSE composite during this 18-year secular bull run? Most importantly, what can we learn using the same tool in the present day? This is the same NYSE composite. It's a monthly chart. We've just zoomed in now. This is 1982 and this is 1984. Clients and regular viewers know that we've covered potentially bullish facts related to 1982 and bullish facts in hand that align also with 1984. You can make an argument that this consolidation period here and this bullish breakout here in 1984 is similar to the present day. The blue line here is the 50-month moving average. If we fast forward to 1987, we can see after this breakout here in 1984, we had a big move in stocks that lasted a long time. And we know that steep slopes on charts are often followed by normal and to be expected retracements. And on this time frame, the 1987 crash is basically a normal retracement within the context of an ongoing uptrend. Price held above the 50-week moving average here. And in this case, our full-bore bullish look would be price above the moving average, and the slope of the moving average is positive. We have all of that here. In fact, it was in place the entire time since stocks broke out in 1984. Price is always above blue, and the slope is up. After the bottom in 1987, we rallied into 1989, and this example here is a reminder that not all consolidations are followed by bullish breakouts. In this case, we get a bearish breakdown. The longer we move sideways, the bigger the move we can expect to get. That's a sharp drop, and we come back and test the 50-month moving average. Similar to this retest here, we come back and kiss the 50-month, and then the ongoing and existing uptrend resumes with stocks rallying into 1994. Market needs to consolidate its gains, and in this case, we know the consolidation was followed by a bullish breakout. Notice this entire time, for the most part, price is above the blue line and the slope is up. This is a secular bullish trend, a long-term, multi-year secular bullish trend. We get a steep advance and a normal give back here in 1998 relative to this trend. And then the broad NYSE Composite Index rallies into the year 2000. Keep in mind, this is a monthly chart. It only shows price once a month at the end of the month. If we fast forward into calendar year 2001, now we see something different has happened. And this quote applies. Technical analysis reflects the vote of the entire marketplace and therefore does pick up unusual behavior. By definition, anything that creates a new chart pattern is something unusual. During this entire advance from the breakout in 1984 all the way up to this point, price has never fallen below the 50-month moving average. This looks different. It's telling us something might be changing. We also have a consolidation box followed by a bearish breakout. And in this case, we came back up and tested the 50-month moving average. That test failed, and then price continued the ongoing downtrend. This is a normal retracement within the context of an ongoing downtrend. As we've mentioned several times in these videos, stocks bottomed in 2002 in October, But the real and lasting bottom didn't come until calendar year 2003. And then we had a sharp rally into calendar year 2005. And this looks a lot better now. Now price is back above blue, and blue starting to turn back up here. So this profile here starting to look more like this side of the graph. The probability of good things happening with price above blue and blue turning up is quite a bit better than the probability of good things happening here. And indeed, good things happen as we turn up. Price rallies into calendar year 2007. And similar to this point here, price comes back and tests the upward sloping 50-month moving average in blue. And similar to this point here in 2001, that test fails and price drops below it. Price below it, lower probability. Price below, lower probability. And as we know, really bad things happened into calendar year 2009. And we can see the slope of the line flattens out and also rolls over during the bear market. So full bore bearish looking here with price below the MA and the slope rolling over. Full bore bearish, price below, and the slope rolling over here. Fast forwarding to calendar year 2011, we bottom. Now we have a better look, but this isn't full bore bullish because the slope of the line is still down. This doesn't look as good as this or this. And with the downward sloping 50-month moving average, price again drops below it. This is that scary look here. Scary look, bad things happen. Scary look, price below, bad things happen. 2011, scary look. But in this case, bad things don't happen for a long time. Rather than going into a longer-term bear market, rather than going into a longer-term and greater magnitude bear market, price in this case rights itself. This looks different than this and this. It tells us something about the battle between the bulls and the bears. We can also see the 50-month starting to turn back up, which is similar to this point here in 2004 after that good things happened. And in a similar manner, after we get back to the full bore bullish look, good things happen. Then we consolidate and roll over. Eventually, this is consolidation in calendar year 2014 and 2015. We get a bearish breakdown, and once again, we have a setup. This, and this look similar. In these two cases, very bad things happened. With a look like this, we want to place a higher emphasis on capital preservation relative to trying to grow our capital. But once the evidence improves, we can start moving back to more of a mixed look, and then we can focus on growth again in 2017. If we take a big step back, what can we learn from this chart? This is a secular trend. This is consolidation and confusion. And notice during the consolidation and confusion period, every time price comes back to the 50-month moving average, it fails. Comes back, it fails. Comes back, it doesn't fail here. This is the change. This is the different look telling us something might be different here relative to here and here. And now we came back and had a successful kiss of the 50-month moving average. This looks more like 1984, we hold above. 1987, we hold above. 1991, a kiss, we hold above. 1994, we consolidate above an upward sloping 50-month moving average. This is what a secular trend looks like. This is what consolidation looks like. And it's possible now that we've shifted back to the secular bullish trend look with the breakout from the box. We're also seeing breakouts in other markets. This is VT Global Stocks 2013, bullish breakout 2017 from the box. The longer a market moves sideways, the bigger the move that we can expect to get. This is the Dow Monthly on Thursday, January 26th. These are nice looking and convincing looking candles. This is strong buying power at a very, very important point. This here looks different than this period here in April of 2015, and this period here late in calendar year 2015 for the German DAX. And if we look at the EFA ETF, which is Europe, Australia, Asia, and the Far East, we have a long-term consolidation pattern followed by what appears to be an attempt at a bullish breakout. Like all breakouts, we really don't know if this is going to hold, and we'll only know if this is successful in hindsight. But the longer we stay above, the more meaningful it becomes. Just like the S&P 500, it broke out and then it came back down below these types of lines during the election. Price could come back into this area here, and it doesn't necessarily mean the breakout is doomed from a long-term perspective. From an investor psychology perspective, we have somewhat of a bottoming formation here with an inverse head and shoulders look and a bullish breakout above the neckline. We know the weight of the evidence speaks to multiple time frames. We just looked at daily charts. These are the weekly charts with the 30, 40, and 50 week, for illustrative purposes only, moving averages here. This is the look we want. This is the bullish turn, 2003, 2004, bullish turn, 2009, 2010. How does the same chart or moving average profile look on Friday, January 27th? If we look at the NYSE weekly first, we can see numerous things. This turn here is similar to this turn here and this turn here. This is still a constructive full-bore bullish look. And on the weekly chart, January 27th at 2:05 p.m., we're also trying to nail down a bullish breakout or a close above these highs. We also have a similar and constructive look. This is observable. I can see it. And remember, we originally did this analysis in August of 2016, and you can see the entire time, despite all of this volatility in price, we've maintained that full-bore bullish look. And another way that this hard and observable evidence helps us ignore all the doomsday forecasts is we never, during this entire bout of volatility, this never starts to look like this or this. Just as the expression "this time is different" is dangerous during bull markets, this time it's different with tulips. This time it's different with .com stocks. You can't lose money on housing because something is fundamentally different. We know the expression "this time is different" can be very, very dangerous in the financial markets. This time is different, bad things happen. This time is different, bad things happen. That can also apply to this time is different, and you can miss when good things happen. Is it possible that these breakouts fail? Absolutely, positively, yes. And if they do, all of the charts that we've been looking at on multiple time frames will start to roll over and reflect deterioration. Just as we could see the improvement and measure it in and around the election, we'll be able to see the deterioration and measure it and react if needed. We just covered a real-world anecdotal case where forecasting or the fear of what may happen wasn't particularly helpful, and the hard data and facts were helpful. This is an example of the hard data and facts that we have in hand today. Our purpose here is not to forecast. We use charts to monitor and adjust rather than anticipate and hope. Are we allocated properly based on what we know today? The answer is yes. We have no idea what's going to happen tomorrow. At some point, the answer to that question becomes no. Are we allocated properly? Not anymore. Are we allocated properly? Not anymore. The only way that we can react to these negative flips in the data is if we head into next week and head into every week with that always important, flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.